It is Monday, March 9th, 2026. Two things happened on the same day, March 6th, 2026, that most silver analysts are treating as separate stories. They are not separate stories. They are two data points that, when placed next to each other, tell you something specific about the physical silver market that no price chart can show you. Event 1. PBOC Governor Pan Gongsheng confirmed at a press conference on the sidelines of China's annual parliament meeting that China will flexibly and efficiently use monetary policy tools, cuts to the reserve requirement ratio and interest rates, to support growth in 2026. The announcement came as Pan noted that the U.S.-Israeli war on Iran has led to a sharp spike in risk aversion in global financial markets. Metal Sedge. Event 2. On March 6th, Hong Kong Customs announced it had thwarted two suspected smuggling attempts involving air freight at Hong Kong International Airport, seizing approximately 168 kilograms of suspected gold flakes and 285 kilograms of suspected silver flakes. The haul, with an estimated market value of roughly $230 million, approximately $29.4 million, marks the largest precious metals smuggling bust on record by value for the agency. Y charts, same day, March 6, 2026. China's central bank announces it is injecting more liquidity into the world's largest silver-consuming economy, and at the same airport, customs officers are pulling 285 kilograms of silver, concealed inside fake cleaning machines destined for Japan, off a cargo plane. Let me show you what those two events mean when you combine them with the 5 structural facts that were already in place before March 6th. Because the combination of a stimulus announcement and a record smuggling bust on the same day is not coincidence. It is the market telling you something specific about the gap between the paper price and the physical reality. Every number I give you is public and verifiable. Links are in the description. Section 1. The stimulus math. What PBOC rate cuts actually do to silver demand. Before I show you the smuggling bust in detail, I need to walk you through exactly why China's monetary policy announcement on March 6th is directly bullish for silver. Not theoretically, but mechanically. China's government unveiled a slightly lower growth target of 4.5 to 5% for 2026. Beijing's finance minister announced a special 100 billion yuan fiscal financial coordination fund to boost consumption and private investment, combined with a 250 billion yuan special treasury bond quota for the consumer goods trade-in scheme, a stronger policy push than last year's 300 billion yuan allocation. Financial content. Here is the specific transmission mechanism from Chinese stimulus to silver demand. China is the world's largest manufacturer of solar panels, electric vehicles, and consumer electronics. All 3 product categories use silver as a critical input. Solar panels use silver paste in photovoltaic cells, approximately 20 milligrams per cell, 10 to 14 grams per panel, multiplied across hundreds of millions of panels. Electric vehicles use silver in electrical contacts, power electronics, and charging infrastructure. Consumer electronics use silver in circuit boards, connectors, and display components. China controls 60 to 70% of the world's silver output. Under the new export control rules effective January 1, 2026, companies must secure government licenses to export silver, with eligibility limited to state-approved firms producing at least 80 tons annually and holding $30 million in credit lines. This move effectively blocks small and mid-sized exporters, reducing international supply almost overnight. JM Bullion. So the specific combination on March 6th is this. China announces it is accelerating domestic consumption through rate cuts and fiscal stimulus. That means more solar panels, more EVs, more electronics manufactured inside China. Each additional unit of production requires silver. That silver comes from China's domestic supply first, because only 44 companies are approved to export silver under the new measures in 2026 and 2027. Newstrack. The silver that goes into domestically manufactured products does not get exported. It gets consumed inside China, and the silver that would normally flow outward to Western vaults through the old quota system, the system that has been in place since 2000, is now controlled by 44 licensed entities who answer to the Ministry of Commerce. More stimulus, more domestic consumption, less silver available for export, simultaneously, on the same day. Section 2. The smuggling bust. What 285 kilograms of hidden silver tells you that the price chart cannot? Now let me show you exactly what happened at Hong Kong International Airport on March 2nd, 4 days before the announcement, and why this is one of the most important data points in the silver market right now. Hong Kong Customs detected 2 air freight smuggling cases of suspected precious metals on March 2nd and seized about 168 kilograms of suspected gold foil and about 285 kilograms of suspected silver foil, with a total estimated market value of about HK $233 million at Hong Kong International Airport. Both cases represent the largest precious metals smuggling cases detected by customs on record in terms of the seizure market value. Based on risk assessment, Customs examined 2 outbound air cargo consignments declared as carrying multifunctional cleaners and UV cleaners departing for Japan. Upon inspection, Customs officers found the batch of suspected gold foil and suspected silver foil concealed in over 4,000 cleaners from the consignments. Metal Sedge 4,000 cleaning machines, each one containing hidden silver foil, bound for Japan, declared as household appliances. Senior investigator Ho Ting Chun of the Customs and Excise Department Syndicate Crimes Investigation Bureau said precious metal prices have soared in recent years, and that Customs has been monitoring the smuggling situation and noticed an upward trend since last year and has mounted various operations. Financial content and upward trend in precious metals smuggling since last year, with targeted enforcement deployments. That sentence means this was not one-off criminal activity. It is a documented and growing pattern of physical silver leaving China through unofficial channels because the official export channels are restricted to 44 licensed entities. Here is the economic logic that makes this smuggling operation rational. The Shanghai silver premium over Western spot prices has been running at 12 to 13%. At $85 per ounce Western spot, that is approximately $10 to $11 per ounce that a smuggler captures by moving physical silver from China to Japan, a country with its own silver premium and without China's export control restrictions. On 285 kilograms of silver, approximately 9,263 troy ounces, a $10 per ounce arbitrage represents $91,630 of profit on a single shipment, against the risk of a 7-year prison sentence and a HK $2 million fine. With only 44 companies obtaining export qualifications, export rights will be concentrated, and frictions in the approval process will increase. This approach will help secure silver within China, but will affect companies and investors outside China in accessing silver. Investing.com. When the premium between two markets becomes large enough that people are willing to hide precious metals inside 4,000 fake cleaning machines and risk 7 years in prison, that premium is not a temporary market inefficiency. It is a structural signal. The official arbitrage channel is closed. The informal arbitrage channel, criminal smuggling, has activated. And the fact that this is a documented upward trend, not a single incident, means the premium has been wide enough and persistent enough to support a smuggling industry. The paper price at $81.38 this morning does not reflect that premium. It does not reflect the 44 company export restriction. It does not reflect the 285 kilograms of silver that someone decided was worth the criminal risk to move out of China 4 days before the PBOC announced more stimulus. Section 3, the 5 structural facts, what was already true before March 6th. The March 6th stimulus announcement and smuggling bust sit on top of 5 structural facts that were already in place and publicly documented. Let me give you all 5 precisely. Fact 1. 6 consecutive years of structural deficit. Analysts estimate that supply deficits of 115 to 120 million ounces this year are straining global inventories as mine production fails to meet consumption for a 6th consecutive year. Metals daily. Each year's deficit represents silver that was consumed and cannot be returned. The cumulative deficit from 2021 through 2025 is approximately 820 million ounces, nearly equivalent to 1 full year of global mine production. That silver is gone. It is in products. It cannot be recalled. Fact 2. COMEX registered inventory at 64% below 2020 peak. The registered vault, the silver that is actually available to satisfy futures delivery, has fallen from approximately 240 million ounces in April 2020 to approximately 86 million ounces today. That is a 64.1% decline over 6 years, while paper open interest has remained elevated. The coverage ratio, registered inventory divided by open interest, is currently 0.20. For every 5 ounces of paper claims, there is 1 ounce of deliverable physical metal. Fact 3. Elon Musk's public warning on record. Musk responded to a post on his X social media platform that noted China will begin requiring government licenses for companies to export silver starting January 1st. He said, "This is not good. Silver is needed in many industrial processes." J.P. Morgan. That quote is not from a gold bug or a silver newsletter. It is from the CEO of Tesla, a company that uses silver in every vehicle it manufactures, posting publicly on the world's largest social media platform about a supply shock that affects his company's production costs directly. When an industrial consumer of silver at Tesla's scale says publicly that a supply restriction is not good, that is a primary source document about physical demand. Fact 4. SHFE inventory at lowest since 2016. Shanghai Futures Exchange silver warehouse inventory has fallen to levels not seen since 2016. China is simultaneously the world's largest silver consumer, the world's largest silver refiner, and now, through the export control system, the world's largest silver hoarder. The metal that used to flow outward from China to Western vaults is staying inside China. The SHFE inventory decline reflects domestic consumption absorbing supply that previously went global. Fact 5. The Michael Oliver historical precedent. In 2005, China stockpiled gigantic, never-before-seen amounts of base metals like copper. Chinese demand from 2005 basically tripled the copper price within about a year's time frame into 2006. The silver setup in 2026 is structurally more severe than copper in 2005. Fortune. The 2005 copper precedent is documented history. China decided it needed copper for its industrial build-out. It bought aggressively. The price tripled in 12 months. Silver in 2026 has the same buyer, China, combined with export controls that prevent the Western market from accessing Chinese supply, even if the price rises enough to incentivize it. In 2005, high copper prices eventually brought more copper supply to market. In 2026, high silver prices cannot bring more Chinese silver to the Western market without Ministry of Commerce export license approval from one of 44 authorized entities. Section 4. The bear case. Why this story may not play out the way the bull narrative implies. I always give you both sides. The bear case on the China stimulus plus smuggling bust thesis is serious and you need to hold it. The silver export licensing system is not a blanket export ban. With 44 companies obtaining export qualifications, export rights will be concentrated, but exports are not prohibited. The system introduces uncertainty and friction for overseas buyers, but it does not eliminate supply. CBS News, CBS. That is the most important bear argument. The 44-company export system creates friction. It does not create a wall. Chinese silver can still leave China through licensed channels. The smuggling bust suggests that the official channels are creating enough friction to make criminal arbitrage profitable, but criminal arbitrage at $29 million is a signal of tightness, not proof of impossibility. If the Western premium rises high enough, licensed exporters have strong incentive to increase their officially approved shipments. The export controls create a bottleneck. They do not create a blockade. The second bear argument. The stimulus impact on solar demand may be weaker than expected. Solar silver demand is falling 7% to 194 million ounces as manufacturers like Longai replace silver with copper in photovoltaic cells. Mass production of copper-based cells begins Q2 2026. JM Bullion. If Chinese stimulus primarily flows into sectors that are actively reducing their silver intensity, solar being the clearest example, the demand side of the stimulus bull case weakens. More money in Chinese consumers' pockets does not automatically translate to more silver consumption if the manufacturing processes consuming silver are being re-engineered to use less of it. The third bear argument, rate cuts take time. The PBOC's announcement on March 6th is a signal of intent. China signaled it will maintain economic support but refrain from ramping up stimulus, underscoring a shift from defending against U.S. tariffs to securing growth longer term. Yahoo Finance. The language is flexibly and efficiently use monetary tools, meaning rate cuts will come when conditions warrant, not immediately. The transmission from PBOC rate cut announcement to actual increase in silver-consuming manufacturing activity takes 6 to 12 months minimum. The silver market at 81.38 today is not pricing a demand increase that will not materialize for 3 to 4 quarters. The fourth bear argument. The smuggling bust proves the system is working. Customs has been monitoring the smuggling situation and noticed an upward trend since last year and has mounted various operations. Financial content, Hong Kong Customs, caught this shipment. That means the enforcement mechanism is active and improving. A more effective enforcement posture means fewer successful smuggling operations, meaning the informal arbitrage channel that the bust reveals may actually be closing, not opening further. The largest bust on record may represent peak smuggling activity, not the beginning of an escalating trend. Hold all 4 bear arguments. The structural bull case is real. The near-term translation to price is not guaranteed on any specific timeline. Section 5. The Copper 2005 Comparison. What Michael Oliver's historical precedent actually says. Let me give you the specific 2005 copper data that the Michael Oliver comparison is built on, because precision matters when you are using historical precedent to inform a current market analysis. In 2004, copper traded at approximately $1.30 per pound. China's industrialization drive, building the infrastructure for its manufacturing economy, required enormous quantities of copper for electrical wiring, construction, and industrial equipment. Chinese copper consumption grew by approximately 15 to 20% per year from 2003 to 2006. By early 2006, copper had reached $3.90 per pound, a 200% increase in approximately 18 months. China is going to take care of its ongoing and upcoming silver demands first. Export controls 2026 to 2027. The demand for industrial silver applications in solar panels, in cars that are now often electric in China, means they have to have silver. Fortune. Here is where the 2026 silver situation is structurally more constrained than 2005 copper. In 2005, copper prices could signal to copper miners globally to increase production. Higher prices incentivize more mining, more processing, more supply coming to market. The response lag was approximately 2 to 3 years, but supply did eventually respond and copper prices moderated from 2008 onward. In 2026 silver, the supply response mechanism is broken in two specific ways. First, mine supply is constrained by declining ore grades, byproduct status, and long development cycles. High prices of 2026 will not translate into new output until at least 2033 to 2036. In the 7 to 10 years before that, the supply curve is essentially locked. Metals daily. Second, even if new silver mines were permitted and built tomorrow, the refining capacity for that silver is concentrated in China, which controls 70% of global silver refining infrastructure. Silver mined in Peru, Mexico, or Australia still largely flows through Chinese processing before reaching final product form. The country that controls refining capacity can affect supply availability independent of what happens at the mine level. The 2005 copper analogy is directionally valid. The 2026 silver constraint is structurally more severe because both the demand surge and the supply bottleneck are controlled by the same actor. Section 6. Paper traders versus stackers. What the physical premium actually means for each group. The description for this video uses a specific framing. Paper traders own promises, stackers own bars. I want to give that distinction a precise, data-based meaning rather than a rhetorical one. Alicia Garcia Herrero of French investment bank Natixis said the export control measures are aimed at meeting domestic demand for solar and electric vehicle-related needs, and told South China Morning Post that if China applies export license requirements very strictly, silver prices could reach $100 per ounce. Investing.com. That is not a stacker or a gold bug. That is the chief economist for Asia Pacific at Natixis, a major French investment bank, saying on the record that strict enforcement of China's export licensing system could produce $100 silver. The $100 number is not from a Permabull YouTube channel. It is from an institutional economist at a GSIB bank. Here is what $100 silver means specifically for paper traders versus stackers. A paper trader holding a COMEX silver futures contract at $81.38 will participate in any price appreciation, but they hold a claim against a vault with a 0.20 coverage ratio. If the delivery stress I have documented in prior videos results in cash settlement rather than physical delivery, the paper trader receives dollars at the settlement price. They do not receive metal. They receive the paper value of metal that the exchange could not physically deliver. A stacker holding physical silver, bars or coins in their possession, holds the metal itself. If the premium between physical and paper widens from its current $4 to $6 per ounce to $20 to $30 per ounce, as it did during the 2021 retail demand surge, the stacker's metal is worth the physical premium, not the paper price. The paper price is a floor, not a ceiling, for physical silver when delivery stress is active. Physical versus paper silver may trade at different prices because physical holdings get tighter. Commodity markets love uncertainty. Short-term spikes or pullbacks are likely. JM Bullion. The practical implication: the China stimulus announcement and the smuggling bust are physical market signals. They do not directly move the COMEX paper price in the short term. What they do is widen the gap between what physical silver is actually worth in the market that requires physical delivery, Shanghai, and what paper silver is priced at in the market that settles mostly in cash, COMEX. That gap is what the smugglers were arbitraging at criminal risk. It is what industrial buyers are locking in through direct mine deals. And it is what eventually forces the paper price to reprice toward the physical reality. Section 7. What to watch. All free, all public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on any paid service, that is not me. You find me here and on X where the data breaks when it happens. Your specific watch list from the China story through the end of March. PBOC rate cut and RRR cut announcement dates. The March 6th announcement was a signal of intent. Watch for the actual implementation dates when the rate cut and reserve requirement reduction take effect. Each implementation date is a step function increase in Chinese domestic liquidity that flows into manufacturing activity and ultimately into silver consumption. The PBOC publishes these on its official website in both Chinese and English. Hong Kong Customs Enforcement reports. Customs has mounted various operations targeting precious metals smuggling and noted an upward trend since last year. Financial content. Any subsequent bust announcement, whether larger or smaller than the March 6th record, tells you whether the premium differential is widening or narrowing. A second record bust within weeks means the premium is still wide enough to support criminal arbitrage at scale. A dry period of no further busts suggests the enforcement crackdown has deterred the informal channel. SHFE silver inventory updates, published weekly on the Shanghai Futures Exchange website. Track the weekly change in SHFE warehouse silver inventory. If Chinese stimulus is accelerating domestic consumption, SHFE inventory should continue falling. If inventory stabilizes or rises, it signals that domestic consumption is not absorbing the available supply as aggressively as the stimulus narrative implies. 44 company export license activity. The Ministry of Commerce publishes export license data on a quarterly basis. Watch for any reports of licensed exporters shipping significant volumes to Western markets, specifically to COMEX registered vaults or LBMA good delivery warehouses. An increase in licensed Chinese silver exports would directly relieve the Western supply pressure and is the primary bear case data point to monitor. The $100 threshold. Natixis said $100 if China applies the export licensing requirements very strictly. Watch the monthly enforcement data from China's Ministry of Commerce for any indication that license approvals are being tightened further or loosened. Tighter enforcement narrows the gap between 44 licensed exporters and a de facto export ban. Looser enforcement widens the supply availability and weakens the $100 case. Section 8, the honest conclusion. Here is the complete picture as of Monday, March 9, 2026. On March 6th, PBOC Governor Pan Gongsheng confirmed China will flexibly and efficiently use reserve requirement ratio cuts and interest rate reductions to support growth in 2026, noting that the Iran war has led to sharp rises in risk aversion in global financial markets. Metal Sedge. On the same day, March 6th, Hong Kong Customs announced the seizure of approximately 168 kilograms of suspected gold foil and 285 kilograms of suspected silver foil concealed in over 4,000 cleaning machines at Hong Kong International Airport, the largest precious metals smuggling bust on record by value at HK $233 million. Y charts. Only 44 Chinese companies are authorized to export silver in 2026 and 2027. Newstrack China controls 60 to 70% of the world's silver output. JM Bullion Elon Musk said publicly, "This is not good. Silver is needed in many industrial processes." JP Morgan Natixis, chief economist for Asia Pacific, said, "If China applies export license requirements very strictly, silver prices could reach $100 per ounce." Investing.com. The stimulus announcement tells you Chinese domestic silver consumption is being actively accelerated by the world's largest central bank. The smuggling bust tells you the premium between Chinese physical silver and Western paper silver is wide enough that organized criminal networks consider it worth a 7-year prison sentence to exploit it. The 44-company export restriction tells you the official arbitrage channel that would normally close that premium is structurally constrained. And the Michael Oliver 2005 copper comparison tells you what happens historically when China decides it needs a specific metal and begins accumulating it seriously. Paper traders own the COMEX price. Stackers own the metal. The gap between those two things is what 285 kilograms of silver hidden inside 4,000 fake cleaning machines looks like in the physical world. Whether $100 silver happens this month, this quarter, or this year is a question the data will answer on its own timeline. What is not a question is whether the structural forces driving it are real. They are documented, they are public, and 2 of them happened on the same day, March 6, 2026, while most of the Western financial media was writing about oil prices. Invest with logic, not hype. Protect your capital. China just told you 2 things on the same day. The rate cuts tell you where the demand is going. The smuggling bust tells you where the physical premium already is. Drop China Watch in the comments if you are tracking the PBOC implementation dates and SHFE inventory. And drop $100 this year or show me the data to tell me where you think silver trades before December 31st, 2026.